Hello everyone, today we will focus on Chapter 4, the financial market. Chapter 4 looks at equilibrium in financial markets and the determination of the interest rate. It shows how monetary policy affects the interest rate. Every 2 months, the Governor of the South African Reserve Bank announces the decision taken by the Monetary Policy Committee, or MPC, on changing the interest rate and the likely effect this will have on the South African economy. The model of economic activity we developed in Chapter 3 did not include an interest rate, so there was no role for the South African Reserve Bank and its governor. This was a strong simplification and it is time to relax it. In this chapter, we shall introduce the simplest model needed to determine the interest rate. The demand for money. This section looks at the determinants of the demand for money. But before we start, let's look at the difference between money and wealth, since they have specific meanings in economics. Money, which you can use for transactions, pays no interest and it is a stock variable. Wealth is the value of all your financial assets minus all your liabilities and it is a flow variable. Barter economy. An economy with no medium of exchange and where goods are swapped for other goods is known as a barter economy. There has to be a double coincidence of ones in a barter economy. Barter economy problems. What happens if Johnny does not want a chicken for his apples? What happens if Johnny wants more than one chicken for his crate of apples, or Mahir wants more apples for his chicken? Apples can go bad, while the chicken can live for a long time. What happens if Johnny runs out of apples? Functions of money. Money has 4 main functions. Firstly, money acts as a medium of exchange. The benefit of holding money is that it economizes on time and effort spent in a barter economy. Secondly, money serves as a unit of account, such that it is a standard unit or agreed measure for quoting or stating prices. In South Africa, prices are quoted in rands. Since money serves as a unit in which accounts are kept, it helps define debt obligations, determine taxes owed. The third function of money is that it may be a store of value in the sense that money can be used to transfer purchasing power from present to future. Through saving, consumption is postponed. Finally, money is a standard of deferred payment as it is an accepted way to settle debt. 2 types of money. Money, or M1, consists of currency, coins and bills, and also bank deposits which are immediately available. Bonds pay a positive interest rate I, but they cannot be used for transactions. In the real world, there are many types of bonds. However, for time being, we will ignore this aspect of reality and assume that there is only one type of bond. To have only cash, interest is lost. To have only bonds, daily transactions cannot take place. Therefore, it is clear that you should hold both money and bonds, but in what proportions? This will depend on 2 variables. The first one, the levels of transactions, and the second one, the interest rate earned on bonds. Proportion between money and bonds. So suppose you have saved 500,000 Rand. So let's look at money. If you spend 30,000 Rand per month, you want to have 60,000 Rand in money. And 500,000 Rand minus 60,000 Rand equal 440,000 Rand in bonds. Or if you spend 40,000 Rand per month, you want to have 80,000 Rand in money and 420,000 Rand in bonds. You hold money for unexpected expenditures as well. Then let's look at bonds. Only reason to hold bonds is the interest earned on them. So if bonds paid 0%, the proportion of bonds held would also be 0. As the interest rate increases, more bonds are demanded and less money. For example, If the interest rate is high enough, you may only want to spend 15,000 Rand and keep 485,000 Rand in bonds. Speculative demand for money. Money market accounts. Many people don't hold bonds but interest-bearing accounts at banks. The money is then pooled together to purchase bonds. Speculative demand for money. Expectations are important. If expected that the interest rate will rise, the bond price is expected to fall and people hold more money to avoid losses. If interest rates are expected to fall, bond prices is expected to rise and more people will demand bonds and the demand for money decreases. Deriving the demand for money. Denote the amount of money people want to hold their demand for money by MD, and the superscript D stands for demand. The demand for money in the economy as a whole is just the sum of all the individuals' demand for money by the people in the economy. Therefore, it depends on the overall level of transactions in the economy. However, it is difficult to measure, but it is likely to be roughly proportional to nominal income. So if nominal income were to increase by 10%, demand for money is also likely to increase by 10%. And then we also look at the interest rate. The relationship between money demand, nominal income, and interest rate. So we can write the relation between the demand for money, nominal income, and the interest rate as MD is equal to RYLI, and then we have a negative sign here at the bottom. So MD is money demanded, RY denotes nominal income, Li is the function between interest rate and money demanded, and then we have the negative function. So we read this equation as the demand for money is equal to nominal income times a function of the interest rate. The minus sign captures the fact that the interest rate has a negative effect on money demand. An increase in the interest rate decreases the demand for money as people put more of their wealth into bonds. The relationship graphically. So the relation between the demand for money, nominal income, and the interest rate is shown in this figure. The interest rate I is measured on the vertical axis. Money or M is measured on the horizontal axis. The relation between the demand for money and the interest rate for a given level of nominal income is represented by the MD curve. The curve is downward sloping. The lower the interest rate, the higher the amount of money people want to hold. Increase in nominal income. This figure shows the increase in nominal income. For a given interest rate, an increase in nominal income increases the demand for money. In other words, an increase in nominal income shifts the demand for money to the right from MD to MD prime. For example, at interest rate I, an increase in nominal income from RY to RY prime increases the demand for money from M to M prime. Determining the interest rate, money supply comes from the central bank, and we will assume that the only money is currency. Money demand, money supply, and equilibrium. The central bank decides the amount of money equal to MS is equal to M. The superscript S stands for supply. In equilibrium, MD, which is money demand, is equal to MS, money supply, which is the same as RYLI, which is the money demand, is equal to M, the money supply. The equation tells us that the interest rate must be such that given their income RY, people are willing to hold an amount of money equal to the existing money supply M. The relationship is the basic LM model. The letter L stands for liquidity. Economists use liquidity as a measure of how easily an asset can be exchanged for money. The demand for money is also the demand for liquidity.